Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. The U.S. and India have reached a trade agreement that will cut tariffs on Indian goods. The U.S. President Donald Trump says he will lower his 25% markup on Indian goods to 18% after the Indian Prime Minister Narendra Modi agreed to stop buying Russian oil. Trump is also removing the extra 25% markup on Indian goods that he applied in response to India purchasing that crude. Shares of Eldorado Gold and foreign mining taking a hit. Eldorado's buying foreign mining for $3.8 billion to create a gold and copper mining company. Some analysts note the transaction may raise concerns about Eldorado adding more startup projects and integrating a copper-focused asset. The deal will bring together development projects in Greece and Saskatchewan. The combined company is going to be headquartered in BC under the Eldorado Gold name. 5N Plus, one of the best performing stocks on the TSX today, after the semiconductor and materials producer says it plans to expand its solar cell production capacity by 25%. 5N says the increased capacity is expected to gradually come online in the second part of the year. It comes after the company got an $18 million investment from the Pentagon to expand its germanium refining capacity in Utah. Shares of Disney falling today. The media and entertainment giant beat profit and revenue in its latest quarter, but gave an outlook that disappointed investors. Disney says it expects operating income in its entertainment unit to be flat compared with the year before, and expects only modest growth at its parks and cruises segment. The tepid outlook due to increased costs and headwinds related to international visitors. Here's where we stand right now on the TSX. It is a 206-point move up, but that was after a 1,000-point plus drop on Friday, so still in the 32,000-point range. Let's go south of the border. The S&P 500 gaining 41 points, 0.6%. The Dow Jones up over 1% right now, a 527-point move. The Nasdaq 129 points up today. That's about a little over half of 1%. Our next guest says January told a tale of two markets. Joining us is Brian Belsky, CEO and CIO of Cumulus Investment Strategies. Thanks for joining us today.
Hey, thanks a lot for having us. Good afternoon, Canada.
What was the big picture for January? What did it tell us?
Well, I think we saw, quite frankly, a lot of broadening out across most markets, especially in North America relative to some other areas. And so I think that's very healthy for the market. What our work has shown is that as we move more into earnings-driven markets versus the multiple-driven markets that we've seen the last couple of years in particular, especially since the fourth quarter of 2022, the return structure of those markets are much less, but they're actually more volatile. Doesn't mean it's not positive, but it just means they're going to be a little bit more volatile. Quite frankly, we think that is positive longer term as investors actually focus more on earnings and less about momentum. So I think what we're seeing in markets, despite all the volatility, is quite positive.
Okay, so what typically drives the broadening phase? What's pushing it?
Well, I think number one, you started to see this notion of dispersion. What does dispersion mean? It just means that not all stocks are created equal, in that you're starting to see differing parts of not only performance but fundamentals across especially areas within technology. We saw a precursor to this in the fourth quarter when many of the quote-unquote Magnificent Seven stocks, or whatever you want to call them, the top 10 largest stocks in the S&P 500, begin to display differing performance. That's kind of number one. Number two, we believe that investors around North America are starting to find, quite frankly, more of the things that we're seeing and have been talking about now for several months. That's being small cap, value, dividend growth, financials, healthcare, some of these names that, obviously are not technology, big cap technology names that have really demonstrated and defined much of the performance in world equities the last several years. So I think that's, again, very positive and why we've seen the broadening out.
Okay, how long can this last? Is there any indication of how long it could last?
I think it's early days. I think, a few years ago, it's interesting, we wrote about that markets are going to normalize. People kind of thought we were we were nuts. And I think ultimately we are going to see more normalized trading. You know, I was a strategist back in the 90s. If you saw kind of and remember back 95, 96 type time period where it was more earnings driven, more fundamentally driven, not just momentum. And it was right before the crazy tech stocks that went kind of parabolic in 98, 99. And so I think we're heading back into that. Maybe it's the start of some also Goldilocks the first part of this year. And then we'll see what happens with the Fed going forward. But our viewpoint is not indicative of the Fed cutting rates. It's more about earnings continue to surprise the upside to the double-digit side of things. And as stocks kind of grow into their multiple versus being driven by their multiple.
And do you think we've started to see that with the earnings so far?
We are very much so. We saw that in the U.S., and I think the big thing for Canada in the first quarter, first calendar quarter, is going to be if the banks in particular can grow into that multiple expansion that we saw last year. Clearly, the material sector has been on fire, and from an earnings growth perspective, it's going to be tough to kind of grow into the multiples in many of these growth and gold names. But, you know, the bank area in Canada is an amazing asset class. We still love Canadian financials, but we think we have to be a lot more particular in terms of just owning all the big six. I think we want to own and be overweight, maybe one or two, not all of them.
Be selective. Okay, so Brian, we've seen small caps and mid caps take off. And as you mentioned, that's part of the broadening out. But what conditions will allow small caps to keep outperforming?
Well, I think it's performance. Performance begets performance. You know, the old notion from the 1980s, greed is good. Probably going to get some emails about that. But from Wall Street, greed is good. I mean, we had great performance on a relative and absolute basis with respect to the small cap markets for the first time in several quarters. The last 3 months, but in January in particular, I think people were shocked by that because they've heard so much bad news about the Russell 2000 in terms of in the United States, the majority of companies don't earn money. Actually, if you take a look at the next layer down, we look at the S&P 1000 companies, the 600 mid cap and the 400 mid cap and the 600 small cap. Those companies are exquisitely positioned from our models. The way we look at that, we actually have the good fortune of running a small mid-cap SMA portfolio for clients in Canada, the United States. Be that as it may, cash flow, earnings growth, balance sheet strength, and actually increased revenue strength from this asset class. That's why we're bullish on small mid-cap.
All right. So what strategies do you recommend for investors to stay focused and stay disciplined? Because we know last year was so volatile. We expect this year to be much along the same lines in the bigger picture.
Well, number one, don't get shook out on politics. Don't let that bother you. Buy really good companies. I know it sounds silly, but our confidence in the fundamental nature of both the Canadian and the U.S. stock market remain very, very high. Turn off all the noise and continue to be very poised and deliberate in your investments. So if you have a great company like Couche-Tard, which, oh, by the way, has been underperforming for a while, you really like that company. There's nothing wrong fundamentally with that company. It's just that some other areas have been outperforming. You should buy more. If you really like Waste Connections, which is another fantastic company in Canada, but maybe from the industrial sector, people have kind of forgotten about, that's an opportunity to buy more. So be disciplined in your process and discipline, stay invested. And when things seem too good on the upside, maybe you take a little bit off the table, but stay invested. All
right, Brian Belsky, got to leave it there, sir. Thank you very much for your time. Appreciate it.
Thank you.
Coming up, following gold and silver's best year in almost 50 years, the metal suffered their worst losses last week since 1980. We'll break it down in a moment. A small village in Quebec hosts critical mineral deposits that could be vital to Canada's self-reliance. CTV's Geneviève Beauchemin has more on that.
Saint-Michel-des-Saints is a small village on the edge of Quebec's vast forests. Its critical mineral deposits could put it on the map of Ottawa's New World Order, this by boosting Canada's self-reliance. Quebec mining company, coincidentally called Nouveau Monde or New World Graphite, hit pay dirt here more than a decade ago.
Our metal detectors was beeping throughout the fairly large area.
Graphite says the company has many uses, including in the defense and EV battery sectors.
So it's about 4.5% grade.
Founder and CEO Éric Desaulniers says that for now, Asia dominates the graphite market.
And the benefit to Canada and all G7 countries is to have a stable source of these critical minerals, but also at the right cost point.
Last year, the mine's financing hit roadblocks as several companies in the EV supply chain faltered.
This is the graphite.
But a test plant is up and running, and in November, Ottawa recognized the mine as a major project of national interest. The federal and provincial governments have invested. To go full steam ahead, the mine still needs to secure financing. Some have opposed the mine, fearing environmental fallout, but the Atikamekw First Nation of Manawan has since signed an impact benefits agreement.
Ouais, c'est ça.
And the mayor of Saint-Michel-des-Saints says he hopes the project will go ahead.
Ça va fleurir à Saint-Michel-des-Saints.
It will bring good-paying jobs to our region hit hard by U.S. tariffs on forestry, says Mario Venn. Families will return and our town will bloom.
This is where you're going to have all the machinery.
Kevin Ducharme is the mine's environmental director. He moved to the region years ago for its lakes, its forests.
It's normal to have concerns with a project like that. We're not in a mining region. People are not used to seeing mines.
He says the company is banking on the best mining practices, the best monitoring systems. There are still many steps to go, but the target date for commercial extraction here is the end of 2028. Geneviève Beauchemin, CTV News, Saint-Michel-des-Saints, Quebec.
So the sell-off in gold continues today after the metal took the largest plunge in over a decade on Friday. Daniel Galli's Director of Commodity Strategy at TD Securities and joins us now to talk some more about this. Thanks for your time.
Yeah, thanks so much for having me.
So correction was widely expected, but why do you think gold continues to sell off today?
Yeah, well, I think anytime that prices move in a parabolic fashion, people start to expect a correction. You just never know when exactly is it going to happen. But I think on Friday, several things happened. First of which is that the president nominated the new chair to the Federal Reserve, Kevin Warsh, who has had at least a decade of a more hawkish tone to him. That certainly played a role, but the microstructure also came into effect, and most notably that some aspects of the Chinese market were closed for participation. And what that meant is that they could neither buy nor sell in a pretty crucial time for the market. Today, we're looking more at things that are more mechanical in nature, the forced selling activity that arises after one of these big declines. And in our view, we've actually probably seen the bulk of that selling activity already.
Okay, forced selling because?
Well, there's an evolution of products that track returns generated by gold and silver on a levered basis. These have to rebalance once daily and are influenced by these kinds of outsized moves in prices such that they are forced to sell or buy commensurately.
Okay, so do you think that's the kind of investor that's driving this right now?
Partly, yes. I mean, ultimately, if we zoom out, the gold trade has evolved throughout a cascade of different buyers. In 2022, it was really about central banks and the de-dollarization theme. That persisted for some time, but increasingly over the course of the end of 2024 and for most of 2025, that's mostly been about institutional participation in gold, which we now think actually is probably at an all-time high. And in the end part of 2025 to date, we actually think it's been overwhelmingly driven by retail participants, whether that be in India, in China, and in the rest of the world, who have bought truly an immense amount of precious metals bullion.
Okay, so the explanation that you've given, which is in many parts, would that also work for the other precious metals sell-off? I know silver is looked at a little bit differently.
Yes, certainly. I think the big difference here between gold and silver is that if truly precious metals were in a bubble heading into this decline in prices, the difference is that you still have a structural demand driver with respect to gold, whereas in silver, we actually think the demand boom that catalyzed the rise in prices over the last several years to begin with is now starting to subside. And here I'm talking about silver's use in solar cells, which we think at these prices are unsustainable. And as a result, we are retaining our cautious outlook on silver.
Okay, so a lot of people have been looking to get into silver. They're looking at the correction now and thinking maybe now is the time to get in, but you don't think so?
Well, we think a lot is going to depend on market psychology, and particularly with respect to retail participants. This truly has been the largest driver over the last 2 to 3 months. And the scale that we're talking about here is something that is unprecedented. So whether or not retail participants will see this volatility and choose to step out onto the sidelines for a period of time is quite possible. In fact, we think that's more likely, but it's also possible that retail will see this decline in prices and find it as an opportunity to buy. Regardless, we actually think that the structural demand drivers, especially with respect to silver, are now in flux. And so we think that the retail participants now have to more than offset that decline in industrial demand.
Okay. Can you reiterate where you think gold will go this year and next?
Well, we think somewhere around current prices is closer to fair value. So we've obviously come off substantially only in a very short period of time. But looking forward, again, gold does have the structural demand from central banks. And in turn, it's harder for money managers to stop out of the gold trade. It's harder for retail participants to stop out of the gold trade. The friction that central banks have embedded into the gold market actually fuel market psychology towards accumulation and towards higher and higher prices. So until central banks really take a step back, I think you'll see a lot of analysts continuing to chase the outlook on gold.
Daniel Gali, got to leave it there, sir. Appreciate your time. Daniel's Director of Commodity Strategy at TD Securities. Coming up, shares of Disney down today. Analysts view the company's outlook with some disappointment. More on why when we come back. Disney beat estimates in their first quarter. Most of the company's profits coming from their parks and cruises. That's a unit led by Josh D'Amaro, who's set to succeed the current CEO, Bob Iger, later in the year. But still, investors not impressed with the outlook. For more, we got more from Ken Leon, he's Research Director, CFRA.
It's the beginning of a new fiscal year, and it's one where we really didn't see all businesses firing on all cylinders. It's also a transition year, as noted, with a change of management. All that leaves investors, I think, a little bit questioning execution risk here. We certainly did see some improvement in operating income, particularly in the streaming business, Disney Plus. But overall, there's lots of puts and takes. Disney with sports segment, with ESPN, it's a tremendous franchise to have. But the sports right cost of getting major leagues has added to expenses and put some pressure on operating income. So I think in total here for Disney, it's how do you get all the different businesses moving in the same direction so that we have a strong quarter. That was not the case with the first quarter just reported.
Can you remind me, are investors still worried about streaming and the enormous investment there and the risk that it won't produce returns?
Well, they are. And you just can't drive subscriber growth without really having a good business and generating positive operating income. It's interesting. Disney has followed Netflix and not really disclosing subscribers anymore. And they just point to nearly a doubling of operating income in the quarter versus a year ago, and getting those margins up to about 8.5%. So that's pretty good. There's more work to be done there. But also, Disney provided less information related to, they have a legacy business, which is the broadcast network business. And that showed, again, a single-digit decline in advertising. So the pivot is happening. And Disney, of course, has to really orchestrate strong improvement in the streaming business because the networks business is still declining.
And it was interesting that the foreign visitors, lots of Canadians, are skipping America as a destination right now for their their travels, and that is not great for the parks business.
Well, you're right. It's not only coming to the domestic parks, but its attendance has been not as strong as expected. Even in Florida with Disney World, for average Americans to take their family to the parks for 1 or 2 days has gotten too expensive. And I think that has impacted the ability of getting stronger revenue growth, but also as they have large capital investments. So, you raise a good question, because really the strategy and North Star, if you will, for Disney is the theme parks, and they expect to spend $60 billion over the next 10 years with new venues and improvements. And then, of course, outside the U.S., the image of the U.S., and Disney is strong, but you watch how they do in markets like Shanghai or in Europe and Paris and anywhere else. These become issues.
The longer term, would you be a holder of Disney? I mean, at one time this was a stock. Well, that may be going back more than a decade. People thought, well, Disney, that belongs in every portfolio.
Yeah, so as investors, we look at Disney in terms of when could they have attractive returns on invested capital and the ability to generate not only higher profitability, but return of capital.
Ken Leon is Research Director, CFRA. Let's have a last look at the markets ahead of the end of the trading day. See if we've got a bit of a comeback for the TSX, which had a dismal drop on Friday, close to 1,100 points. It moved up 255 points so far on the day, so less than 1%, and still hovering 32,178, so low 32,000. The S&P 500 has a 38-point gain, up about 0.5%. And the NASDAQ up about the same, 130-point move for the NASDAQ. Let's have a look at a couple of other movers today. Gold is where we start. It dropped dramatically last Friday as well. So did silver. And it tried to regain a little bit today, but it stays under 4,700 US dollars an ounce. That's a futures contract. So it's up about 1%, just a little over that. And a quick look at silver ahead of the end of the day. Silver is also trying to recover after Friday. So it gained 2.5%. Or $2.05 to $80.58. We want to show you Oracle as well. That company said it plans to raise up to $50 billion using equity and debt to fund its AI ambitions. And that has sent the stock down 2.4%, or almost a $4 per share loss. The closing bell's coming up straight ahead. Stay tuned for that. Here are the closing bells for the end of the trading day. At the NASDAQ, Saudi Tadawul Group rings the closing bell. In New York, Compass International Holdings ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX started to recover today, gaining 260 points, 0.8% after that loss of close to 1,100 points on Friday. The S&P 500 gaining 37, or about 0.5%. The NASDAQ, 130-point move up today, again about 0.5%. Let's get to the movers in Toronto. Eldorado Gold dropping 8.5%, or $4.95 a share, taking to $53.47. The miner announcing a deal today that investors don't seem to like. Let's get to Discovery Silver. It moved down today over 4%, or 40 cents per share. Loss there, down to $9.18. Tourmaline Oil also dropping today. Tourmaline Oil down 4.5%, losing $2.95 a share, and taking the price to $61.49. They got a rating change from TD from a buy to a hold, which moved the stock. Let's go to the green. 5N Plus today, gaining almost 6%. Solar cell production boost for them. Stephanie Hughes has more on that in just a moment. And then Brookfield Business Partners moving up today. It gained close to 5%, taking the stock price to a flat $50, and it's up 57% over the year. Aritzia also a gainer today, stock moving up 6.5%. That's a gain of $7 and a penny. 114.34 is where it ended the day. It's up 63% over the last year. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now. She's been watching the markets today. Stephanie, investors don't like the Eldorado deal. Tell us a bit more about it and why you think investors are against it.
Yeah, so it seems like investors are very negatively reacting to this Eldorado Gold deal. So those shares fell by 15% at their lowest point. In fact, the biggest intraday decline since the onset of the pandemic since March 2020. And that deal that we're describing there, that's the gold producer Eldorado said that it would buy the copper mining company, Foreign Mining, for $3.8 billion Canadian. And now, while the deal adds some mining projects to Eldorado's portfolio, and it's expected to really expand on its Canadian exposure and growth. It was TD Cowen analyst Stephen Green that said that some investors might express some concerns about Eldorado adding a second startup project while it's completing its Skouries project. It's nearing completion there. So it's kind of a concern about adding more workload, adding more cost to the mix while it's getting this other one past the finish line. So his team called the transaction a slight negative for that reason. Of course, when you're talking about Eldorado Gold, it's a precious metals company, so it probably doesn't help that precious metals sell-off is also weighing on the company, and that's prompting Eldorado and other companies like it to give up some of the gains that they've made in January. So bit of a double whammy for Eldorado there, Marella.
Okay, let's get to 5N Plus, big gainer today. Explain a little bit about what they're doing.
Yeah, so 5N Plus is an interesting one. It's not a company that we talk about very often, but its shares jumped by 10% today, crossing a new all-time high for the firm. So the company, which produces semiconductors and other performance materials, they said that they plan to expand their solar cell capacity by another 25% in 2026 through its Azure space unit. The company says it expects that capacity will gradually come online in the second half of the year. So the National Bank analyst team said that this expansion really reflects a strong outlook for the space solar segment, especially after they've already expanded that capacity by 30% last year. So this rally is really building on the other double-digit rally that we saw last Thursday when shares moved up by as much as 19%, when the company said that it was receiving an $18.1 million investment from the Pentagon to really expand germanium refining capacity at its Utah project. So some interesting developments happening with 5N Plus, and you're seeing that reflected in the share price, Marella.
All right, let's leave it there. Bloomberg's Stephanie Hughes, appreciate the update. Coming up, we're exploring what happens when fundamentals and share performance do not align. How do you weather the markets? That's coming up next. Fourth quarter earnings coming in from Palantir right now. Last quarter, the company beat, but investors are concerned about stretched valuation. So let's see how things turned out for the fourth quarter results. Results coming in at $1.41 billion, where the estimate had been $1.33 billion. That was the Bloomberg consensus, so a beat for Palantir there. The adjusted earnings per share coming in at 25 cents. The estimate had been 23. Adjusted EBITDA coming in at $805.5 million. So a very big beat there. The estimate had been 706.8, so almost a full 100 million. The outlook, Palantir sees 2026 revenue coming in at $7.18 billion to $7.2 billion. The estimate had been way under at $6.27 billion. And of course, that's what investors are going to be paying attention to. They like to see forward guidance that's strong. So that has exceeded Wall Street expectations. We'll dig into the numbers and what they mean with Giluria. That's at 4:40 p.m. Eastern time today. And a big earnings weeks, Alphabet, Amazon, Uber, Eli Lilly, Shell, so many are reporting this week. We're paying attention to companies experiencing a disconnect between fundamentals and share performance. Let's do that with Jed Ellerbrook. He's portfolio manager at Argent Capital Management. Jed, thanks for joining us today.
Hey, good afternoon.
What drives that kind of disconnect?
Yeah, I think the stock market today is really focused on accelerating revenue growth, number one. And then also, I think the big rally in kind of commodity type industries has been the trend to start the year. You see that in energy, a lot of the commodities, gold and silver, of course. So I think those have been the two big focus areas for investors just here in the first month of this year. It feels like estimate revisions, valuation has kind of been taking a back seat, and that's really lasted for the last 9 months.
Okay, let's get to Meta and Microsoft, which already reported last week. Have they set the tone for what to expect from big tech this time around? I know Meta sort of dropped after reported, even though it did well, and Meta gained, excuse me.
Yeah. I think that Meta's earnings last week provide a pretty good hint of what's to come from Google here on Wednesday afternoon. The digital advertising business is doing exceptionally well. That business is extremely conducive to AI tools, both in terms of reducing cost, but also generating additional revenues, getting customers to spend more time on the apps, click on one or two more ads because those ads are more relevant. So outstanding results from the digital advertising companies. Microsoft showed us really strong growth from their cloud computing unit. So Google's GCP and Amazon's AWS, Amazon reports Thursday afternoon, that is going to show really strong revenue growth as well. And then I think the other thing you can derive from Meta and Microsoft's earnings last week that will apply to Google and Amazon and others too is continued increases in CapEx spending for data centers. Those estimates, those spending amounts are going to continue to be revised higher. We're almost on year 3 of that at this point.
Okay, so Jed, as you know, investors were looking for that, right? Their return on investment. Are they seeing just the beginning of that in some of these companies? Clearly, it's going to take longer for the others who don't necessarily benefit from the ad revenue, the ad spend there. Is it going to take a longer time for them to see that return? And do you feel comfortable saying it will come?
Yeah, the answer to that question depends so much on what industry we're talking about. If we're talking about digital advertising, absolutely. We are seeing a strong return on AI spending, and you see that in the accelerating revenue growth rates that Meta and Google are posting. If we're talking about traditional enterprise software, no, we are not seeing a high return right now on AI spending. Those software companies are largely maintaining their revenue growth rates or perhaps decelerating slightly. We're not seeing broad-based acceleration. I think that will come. A company like ServiceNow, which reported its earnings last week, is targeting 18 to 19% revenue growth organically for 2026. That closely matches what they did in 2025. But there are some hints that as the year progresses, we will start to see that acceleration. I think that would be great news from investors' point of view. And then if we're talking about the hyperscalers or the cloud computing giants, Google, Amazon, Microsoft, we are definitely seeing accelerating and very high revenue growth rates. So I think there is good evidence of return on data center investment in their case.
Okay, you mentioned software, which has taken a beating down. Do you feel like investors' concerns then are overblown, that concern that AI is going to take over for software?
Software stocks typically trade at high multiples. They have, for a long time. And so if you have a company that trades at, say, 30 or 40 times earnings, what that means is investors are willing to place a lot of value on revenues and profits and cash flows that are 5 or 10 or 15 years down the road. And AI is such a revolutionary change to technology businesses that investors are suddenly not comfortable projecting with confidence that far out. And so I think that's the main reason why we've seen software valuations compress so much. It's not necessarily because investors think ServiceNow is a bad business that's going to stop growing or lose a lot of its customers, or other software companies. It's more that AI poses big questions about what enterprise software will look like, how it will be delivered 5, 10, 15 years from now. And so valuations have compressed. I think there are a lot of software companies that are going to lose customers and revenue because they're not able to keep up with all the new AI tools that are available to deploy today. But there are other software companies that will thrive and do very well. You just talked about Palantir. They just reported earnings. Palantir is obviously a company that has embraced AI, is using it to improve customers' workflows and reduce costs and make them more efficient. Palantir is an obvious AI winner, and that stock has a valuation that reflects it, trading well over 100 times earnings.
Okay, let's get to Amazon very quickly. I'm just wondering how their retail business is doing. We talk about everything else, and they've still got that retail business. Is it expanding? How's it doing?
Yeah, Amazon's retail business is growing about twice as fast as their biggest competitors, which are Walmart and Costco. Those three are taking the lion's share of all U.S. retail growth. So Amazon growing, 11 or 12% year over year in retail, that's a pretty good result. That compares to Walmart and Costco's 5 or 6 or 7% growth. And then I think what really is going to show up for investors here on Thursday is profit margin expansion in retail as Amazon succeeds deploying robots and also just kind of cutting costs. We've seen several rounds of layoffs as they kind of trim back some of their most ambitious projects. So I think we're going to see really good retail margins from Amazon on Thursday. And then if you switch over to the other side of their business, the cloud computing unit, AWS, like I said earlier, we're going to see accelerating organic revenue growth. I think, 23, 24, 25% maybe. The company reported 22% last quarter, if I recall, and it was, I think, 18% the quarter before. So continued acceleration from AWS, I think that's going to be welcomed by investors, but we'll see here in 3 days.
Okay, we will see. Thanks for joining us, Jed Ellerbrook, Portfolio Manager, Argent Capital Management. Canadian chip makers 5N Plus scaling up production with rising demand from space, AI, and defense. We'll take a look at the impact and growth as well as valuation when we come back. Bloomberg reporting that Elon Musk plans to merge SpaceX with xAI. Now, this is coming from people familiar with the matter. The deal encompasses the billionaire's increasingly costly ambitions to dominate artificial intelligence and space exploration. The deal was apparently announced in a memo. Shares of Montreal-based 5N Plus up. The company is stepping up investment in space solar cell production, announcing plans to boost capacity by about 25% in 2026. It comes on the heels of strong backlog growth, rising defense demand, and a new investment from the U.S. Department of Defense. We were joined by Amer Ezat, Managing Director and Deputy Head of Research at Ventum Capital Markets.
And obviously this is booming and they're benefiting from it. The second business is solar cells as well, but terrestrial solar cells, which are also mission critical, and they're the largest supplier to First Solar in a mission critical compound called CDTE. Then the third business is bismuth, which is what you find in Pepto-Bismol. So the two first businesses are growing like gangbusters, and the third one is outsized margins and just high visibility.
Bismuth, the element, yeah, it's interesting, used in Pepto-Bismol. But I thought the solar cells were a kind of commoditized business. How do they're able to compete with the Chinese, for example?
Oh, actually, it's not commoditized at all. When you think about the supply picture out west, there's only 3 Western players that can meet the technical and reliability requirements. And 5N Plus is one of these 3 players. The 2 other players are a division of Boeing and a division of Rocket Lab. And all these 3 players are capacity constrained, hence why the announcement today to increase their production by 25%.
But these are specialty solar cells for use on a space vehicle or a satellite, for example?
Correct. The technical word for what they do is a multi-junction solar cells that are germanium based. And when you think about the different sort of constellations we send into the LEO, MEO, and GEO, they sort of are able to supply their multi-junction solar cells everywhere. The only place where they don't really compete is VLEO, which is the very low Earth orbit.
And then the refining germanium, which we keep hearing a lot about, it's a crucial material in Utah, and they're going to step that up with almost $20 million from the U.S. government?
Correct. So they announced, or the U.S. government or the Department of War, as you mentioned, announced late last week an $18 million investment to expand domestic germanium refining capacity, essentially to 5N plus. And germanium, the way to think about it in very layman terms, is a critical material used in night vision systems, infrared cameras, missile guidance, and the solar cells that power satellites, as we were discussing. So you don't see it as a consumer, but it is essential for modern defense systems, space infrastructure, and advanced imaging. And what's driving urgency is that most global supply has historically come from China. So the U.S. is focused on securing domestic reliable sources, and that's why this funding matters. And this, too, is what's driving the stock price of 5N plus.
And I think a worry is that the Russians, too, have a grip on some of this rare earth market, and they're obviously a risk.
Correct. And that's why 5N plus is becoming a much more critical supplier to the U.S. And I think investors are starting to realize that, hence the stock reaction.
I mean, shares hitting a record high today. Would you be a buyer of 5N plus now with new money?
Definitely. We've got a $30 12-month target and a buy rating. The stock has performed extremely well, but what's changed is visibility. And the risk profile. And when risk comes out of the story and visibility improves, valuation frameworks adjust. Even without near-term estimate changes, recall like all of these sort of investments they're talking about will gradually happen in 2026. So they really hit your 2027 numbers. And what we tell a lot of our institutional clients, if you think you missed it, you haven't. These are multi-year structural tailwinds that are going to drive 5N plus for the next 10 years.
Wow, and they used to be a medical imaging material supplier, but they've certainly put themselves into a sweet spot now, some hot markets.
This is a very small part of the business, actually, that they don't speak about a lot, but it might drive the next leg of growth. We do not assign any value to that currently in our valuation.
Amar Azad is Managing Director, Deputy Head of Research, Ventum Capital Markets. Up next, oil prices decline today as traders consider the possibility of easing tension between the U.S. and Iran. More in a moment. Here are the stories we are following in the newsroom today. The U.S. and India have reached a trade agreement that will cut tariffs on Indian goods. Trump says he will lower his 25% tariff on Indian goods to 18% after India's leader, Narendra Modi, agreed to stop buying Russian oil. Trump says he's also going to remove the extra 25% duty he applied in response to India's purchase of crude from Russia. And Trump getting ready to launch a strategic critical mineral stockpile, $12 billion stockpile aimed at protecting manufacturers from supply shocks and cutting America's reliance on Chinese rare earths and other metals. The reserve will include minerals like gallium and cobalt used in products like iPhones, batteries, and jet engines. Tyson Foods reported sales and profit in its latest quarter that topped Wall Street expectations. But the meat producer's beef business reported a $143 million loss in the quarter. Tyson says it will close a beef plant in Nebraska. As a result, the company narrowed its expected operating loss in its beef segment, but maintained the outlook for the year. And shares of Disney ended the day lower. The media and entertainment giant beat profit and revenue estimates for its latest quarter, but gave an outlook that disappointed investors. Disney says it expects operating income in its entertainment unit to be flat compared with the year before and expects only modest growth for its parks and cruises segment. The tepid outlook due to increased costs and headwinds related to international visitors. Oil prices under pressure today as investors dialed back fears of a supply shock after Donald Trump signaled a possible easing of tension with Tehran. Let's go to Rebecca Babin on this, senior energy trader at CIBC Private Wealth. Thanks for joining us today.
Thanks for having me.
Should investors be a little cautious in assuming that things are going to go quietly resolved between Washington and Tehran?
Yes, I think traders should be very cautious making that assumption. And I think the price action you see today actually reflects that traders are still pretty cautious. We are down 4%, and let's call it $3 in WTI. But if we think about how much premium was built in over the last several weeks, it was closer to like $7 or $8 of kind of risk premium built in as it looked like there was going to be escalation between Iran and the US. So we've given back, I'm going to call it a little less than half of the premium that we've been accumulating, which tells me the market's saying, okay, I'm recalibrating my risk here on a potential supply disruption, but I'm certainly not making the assumption that we are going to see a quick resolution or definitely see a resolution. So this is a market that lives and dies headline to headline on geopolitical risk at this point. And so we're not typically used to seeing 3 to 5% moves, but in the context of the way things are unfolding, this type of action is actually not a panicked or an extreme response. It seems actually fairly calibrated.
Okay, let's talk about what else has changed, sort of the outlook for oil, supply disruptions in Kazakhstan. The U.S. winter storm also put some pressure there. What else is playing in?
Yeah, so in January, crude kind of hit the trifecta, to use a horse racing term, where we had geopolitical risks that rose. We had unplanned supply outages, as you mentioned, in the U.S., impacting 11 million barrels of supply over the course of the last 2 weeks. We had the CPC pipe having restart issues and the Tengiz fire, right? All of those things coalesced at the exact same time. Geopolitical risk was increasing, while at the very same time, positioning was flipping from maximum short in the systematic trading community to a maximum long positioning. So all of these events took place at the very same time. And to put a little context around the size of that positioning move, if we came into January with CTAs looking at max short at around $30 billion, they have now flipped the other way to being long close to $20 billion. So it's a $50 billion kind of net positioning flip. And obviously crude is a very deep market, but that's pretty notable from a positioning standpoint. So the trifecta really hit all three things that create a tremendous amount of volatility for crude traders.
Okay, then we'll get into the next factor here, which is OPEC, of course, announcing it's going to leave production levels where it is for now. But Saudi Arabia has indicated lower oil prices are impacting state revenue. So I'm wondering if you could see them cutting back at some point to support the price.
So this is a great question and a very hot topic of debate, I think, amongst analysts and traders. OPEC has left themselves a tremendous amount of optionality. They're not going to increase production until March, as they stated, but they left themselves the option to either cut in March, increase, or stay flat. Based on what I'm seeing in the marketplace, my assumption is actually that they decide to do nothing for the second quarter. And I say that because in the face of falling U.S. production, if we get into the high 50s, the market is going to rebalance itself a little bit more naturally. And they may not want to give up that market share by cutting at the same time when they think the market might be reaching a level of support. So I don't see them necessarily stepping in as quickly as they have in the past to cut production to support the market, as I think they think the U.S. will be a little bit more responsive. On the other side, I actually don't think I see them increasing dramatically, particularly because we will be in a surplus. This isn't a market that's in a deficit. We're expecting builds. And if they add barrels back, it could have a pronounced impact on price, which I think they want to avoid. So my assumption here is they stand pat. It's obviously very difficult to call, but at this point, that's kind of the way it looks like it's shaping up for me.
Okay, what about China? Is China still stockpiling? And how is the cutoff of Venezuelan oil affecting that country?
That's a great question. So China was a huge stockpiler of oil throughout all of 2025. Estimates vary. It's hard to get a really good read on it, but it could have been at as high as 500,000 to 700,000 barrels a day that China stockpiled throughout the course of 25. Yes, they continue to stockpile into early 26. This is something that the market has started to build into their estimates. So it's reduced the amount of surplus that many analysts are anticipating. If you were seeing about 2.5 million barrels of surplus in the first quarter of 26 into the second half, you might be saying, okay, maybe it's something closer to 1.5, 1.7 based on China's potential stockpiling. So I think they continue to be active. The data is yet to reveal the full amount that we're going to see in 26, but analysts are certainly expecting that trend to continue, particularly in the events of geopolitical risk increasing. And as it relates to Venezuela, I think all of the geopolitical risks we're seeing are impacting China's decision, not just the Venezuelan crude instance, but we have seen commentary from Trump that they should be able to continue to buy Venezuelan crude, but I don't think that changes their calculus. I think they'll continue to be very active.
Rebecca Babin, Senior Energy Trader, CIBC Private Wealth. Thanks for your time.
Thank you.
Up next, we'll break down Palantir's new results just shared after the end of the trading day. We'll also take a look ahead to Google and Amazon, both reporting this week. Back in a moment. Palantir shared their fourth quarter results a short time ago. Let's give you a reminder of where they landed. You can see investors are liking so far what they've read because the stock has moved up over 7% right now in after-hours trading. Revenue coming in for the software company at $1.4 billion. The estimate had been $1.33, so that was the Bloomberg consensus and a beat for them there. Adjusted earnings per share at 25 cents. The estimate was 23. Adjusted EBITDA at $805.5 million. The estimate had been $706.8 million, so a very big beat for them there. Let's start to break some of this down with Gil Luria. He's head of technology research at D.A. Davidson. Thanks for joining us today. As you saw, investors are liking what they've seen so far. Was this a much bigger beat than expected?
Yeah, a much bigger beat than expected. They guided to 60% growth from approximately 60% last quarter, and they grew 70%. These are the magnitudes of beats we don't see anymore. And 70% growth is so much faster than any other software company. Just to keep in mind, so Palantir is by far the fastest software growing company. 2 through 10 are happy to grow 20 to 30%. That's how big the difference is. Palantir's margins are over 50%. That's by far the highest of any software company, including much bigger companies like Microsoft, Adobe, Salesforce, etc. So their results are not only better than expected, they are so much better than any other software company right now. That's what investors are reacting favorably to.
Okay, so we look at the fall off here sort of at the start of the year, January, and now we're into the beginning of February. Palantir looks like it suffered from the same problem or challenge that other software companies have been suffering from, and that's the fear of AI. Why do you think that it has gained as much as it has, or it has growth expectations the way it has? What is it doing right?
So it's doing a few things right. So first of all, they really embed themselves at their customers. They do everything for their customers, from the software itself to customizing it to having people present at the company to implement the software and then maintain it. This is a lot more than most software companies do. Most software companies just sell you the license or the subscription and let you figure out how to implement and maintain it. They do a lot more. They really have found the magic formula for helping companies figure out how to organize their data in a way that allows them to use the most advanced AI tools to accomplish the most important things, the mission critical things for those customers. Now, I just said that relatively simply. This is actually really hard to do. These are skills they've perfected over 20 years or more. But now that they're at this place where AI is so important and organizing data is so important and having an army of 4 deployed engineers implemented is so important that they're just pulling away from the pack. They are unlike any software company. Now, the stock's gone down from close to 200, closer to 150, actually because of its affiliation with AI. Less affiliation with software than with AI. I don't think anybody thinks this company's in threat from AI. Clearly, they're benefiting from it. But they are part of the AI complex. So as people were concerned about bubble this, bubble that the stock traded down to where it is now. And when I say down, I mean it's still trading at 60 times revenue and more than 200 times cash flow. It is not cheap by any stretch of the imagination, but it used to trade at 100 times revenue. So it's come down. It'll go back up a lot tomorrow.
Okay, let's talk a little bit about the government contracts. How big of a part of its business are government contracts, and who would be their other commercial clients?
So the government is still more than half the business, and the U.S. government business at least grew by 66%, which is remarkable because governments don't move fast, and yet they're moving fast to implement Palantir's solutions. On the commercial side, it's really the biggest companies in the world because Palantir doesn't come cheap. The average contract is somewhere between $20 and $40 million a year. Because Palantir not only sells you the software, but again, they deploy an army of forward deployed engineers to help you manage it. So it's the biggest companies in the world hiring Palantir to do the most important things for them. And then because that's working, then the sales process is pretty easy because they'll just let other CEOs and CFOs know that Palantir solved their AI problem. And that's the best sales pitch you can have right now.
Okay, let's get quickly to a preview of Google. Alphabet's reporting this week. People want to know and understand what kind of return on investment they're getting from the AI build-out. We saw Meta getting more traction with ads because they can curate them. Is that what you expect from Google?
Yeah, so the Meta results and the Microsoft results bode well for Google because Microsoft Azure is a very good determinant of how Google Cloud's doing. Google Cloud should be doing pretty well. And then Meta growing ads at such a fast rate, almost 25%, and guiding for as much growth going forward, means that the Google ad business is probably in good shape too, that advertisers are spending more, and it's likely that Google's also having success at serving better ads and charging more for them because of AI. So just like Meta showed that being good at AI is helping the core business, Google is likely to be able to say the same thing this week.
What about Amazon? Of course, it's got its retail business, but it also has its digital forward, its AI business as well. So what do you think for Amazon? What are you expecting?
Well, they're also in pretty good shape. The consumer was pretty strong in the fourth quarter. So the Amazon retail business should be doing well, and they've handled tariffs really well. They're constantly becoming more efficient in reducing the logistics and shipping costs. So the retail business should have had a good quarter. We expect that. And then on the cloud side, on the AWS side, same comment as Microsoft Azure, being a good predictor of AWS results. So we expect AWS to grow at least as fast as they did last quarter. Now, mind you, that's a lot less than Google Cloud and Microsoft Azure, but it's also a bigger business. So it's a bigger base of revenue that they're growing. It should be growing more than 20%, which is very impressive for a business that large.
Gil, got to leave it there, sir, but appreciate you joining us for this. Gil is head of technology research at D.A. Davidson.
Thank you.
South Korea is pulling out all the stops to try and win a bid to build Canada's next generation of submarines. CTV News has learned plans are in the works to sail one of Hanwha's submarines across the Pacific to Canada in the spring. CTV's Judy Trin is in Kojay with that exclusive story.
A deep dive into what could be the biggest defense procurement in Canada's history, the purchase of up to 12 submarines.
Because this has now evolved into a government-to-government situation. It's a big, big procurement. This is going to be a relationship with the winner for years, decades to come.
To persuade, the South Korean Navy plans to sail the KSS-3 submarine across the Pacific and dock in British Columbia, a journey that will take 2 months.
Your hands up here. Okay.
CTV News also got to see Hanwha's pitch up close. We couldn't film because of security protocols, but the attack submarine holds about 50 sailors. It launches vertical missiles that target land and has torpedoes. But the deciding factor will rest on economic benefits. To win the contract, Hanwha is pledging to help hard-hit businesses, like investing $345 million in Algoma to buy its steel and help it build a plant to make beams.
It's been tough as tariffs have been in place for a year and half of our business has gone away.
More than 24 CEOs accompanied the minister on this trip. While some companies are hurting, others are looking for ways to expand. Using robotic technology, Hanwha builds 45 ships annually on its assembly line. Speed Ontario's shipyards want to emulate.
I mean, what they do here is cutting edge. It's absolutely fantastic. If we can bring just a fraction of that to Canada, I think us as a country would be a lot further ahead in our shipbuilding endeavors.
The deadline for Hanwha and TKMS to submit their bids is March 2nd. It's a deal that could be worth $100 billion spread over more than 3 decades. It's investment that Canada needs to protect itself from Donald Trump's trade war. Judy Trin, CTV News, Koje, South Korea.
Coming up next, we'll dive into how artificial intelligence can improve mammograms. Back in a moment. A new study shows that late-stage cancers decreased by 12% when AI screening was used. We got more from Dr. Jean Seeley, head of the breast imaging section at the Ottawa Research Institute.
The study that we're talking about was done in Sweden, and they implemented it for a population-based screening program where they usually in their country do double reading, where 2 radiologists read the mammograms and then decide whether or not they need to call back the patient for additional imaging. Instead of using a second human radiologist reader, they added AI, and for the cases where the AI flagged the mammograms as being higher risk for getting breast cancer, they studied the impact. And what they found was having the second reader as being the AI actually improved the performance of the overall program and reduced the late stage, the delayed or advanced interval cancers by 12%, as you mentioned. So wow. This is a really positive step to show that AI helping the radiologist actually improves the performance of the program.
No kidding. I'm wondering, like, obviously we'll be seeing more of this, I'm sure, in the future. And you suggested that this technology can actually save public health dollars as well. Do you have an estimate in terms of like how much we could see?
Well, we did a study a couple years ago looking at the cost of diagnosing breast cancer according to the stage at diagnosis and using Canadian healthcare dollars. And when we diagnose early stage breast cancer, it costs about $40,000 to $50,000 per patient. But the moment we get into the later stage, for example, the stage 3, which are more likely to be the delayed ones missed by the mammograms, those have a cost of over $200,000. And by the time it's already spread to the rest of the body, we can be in over $360,000 to $500,000. So when we add those costs up, using AI to help us reduce those late stage diagnoses will actually potentially save healthcare dollars.
Jean, what sort of adoption are you seeing with AI in hospitals?
I think you were saying what's the uptake?
What sort of adoption are you seeing at the hospital level to use AI, whether that's enhancing patient experiences or on the research?
It's a great question. It's still early. We have been using it at the Ottawa Hospital for the last year and a half, where I was able to use research funds to actually allow us to study the impact of adding AI to our screening mammograms. It's really early to say, but we are not finding that it increases the false positives when the radiologists are trained properly on how to use it. There is no way that we are ready to use AI as an alternative to radiologists. There are too many false positives where it would recall too many cases. But using it with the radiologist seems to help it, and we are starting to see this across the country where slowly people different radiology practices are starting to use AI to look at how they can improve their performance.
Okay, that was going to be something I wanted to follow up on too, right? Is like this study is based overseas, as you mentioned, but how often are we seeing, or how many areas of Canada are we seeing this technology slowly starting to be used? And to your point, like not alone, but with a radiologist?
Yeah, it's still early, and I would say there's a lot of interest. We're starting at many of the radiology conferences, we're starting to have talks on how this can be adopted. There's obviously the cost of implementing AI. There's there's a lot of hesitation to use it because it has this kind of black box phenomenon. We don't know exactly how it works, and we have to study its impact on human behavior. We can't rely only on AI, and so there's a learning process. So I would say it's still fairly early, but I think it's very promising, and certainly from our experience, early as it is, it's helping us. And certainly from this study from Sweden, this is very encouraging that it's going to help improve the quality of screening mammography and early detection of breast cancer.
No kidding. You mentioned this, though, and I just wanted to dive deeper into that question of how much the actual technology costs. Can you give us a better idea of how much that costs?
It's so variable, and it's also changing, and there are different, and luckily Health Canada will have approval processes for all of the new vendors that are coming out. It's all validated, tested. So it varies depending on how many patients you're doing, how many mammogram units you're doing. It's not insubstantial, and you have to integrate it into the systems to allow the radiologist to see this when they're working. That requires a fair bit of work to implement this. So I would say we probably need help with implementing this across the country. I would like to see us do this more at the programmatic levels in the screening programs so that we can benefit all of the people in the screening programs, not just in a few centers.
And I'm assuming a lot of patients would obviously like to see more of this. Like, have you heard positive feedback so far from women across Canada who know that this could be more available in the future?
I think, and in speaking to my patients, they want us to be able to do the best job possible with the technology that we have. So if it's going to help and improve the quality of the imaging, then the patients would like it. We know from surveys that patients do not want radiologists replaced by AI. They want to have oversight. And I think that's exactly the way we're going certainly in Canada and many parts of the world. It is not ready. We need to have the radiologists integrate with the AI as this very valuable tool to help improve the quality.
Dr. Jean Seeley is head of the breast imaging section at the Ottawa Hospital Research Institute. Snowfall in Nova Scotia could help farmers recover after last year's record-setting drought. CTV's Paul Hollingsworth has more on that.
As this harsh winter continues, making it a challenge for many to get around or just be outside, meteorologist Jim Abraham sees an upside for farmers.
The good news is we're getting a snowpack.
Farmer Alan Melvin says heavy snowfall can be restorative, giving crops a better chance at growing later this year. That's particularly helpful following last summer's record-setting drought.
Some soil protection, some crop protection for things like winter wheat that are in the ground, and then that slow snow melt.
When the weather warms, the dry soil could be replenished in time for Nova Scotia's growing season.
The snowpack is actually more important to farmers and wells and the water resources than heavy rain.
In the winter, when the ground is hard, rain runs into the ocean and rivers, but stored water in the snow melts and runs off slowly, directly into the soil.
And the groundwater amounts increase, and everybody's happy.
Including Jordan Yamey, who lost 30% of her bean crops in 2025 because of dry conditions.
If there's a slow snow melt, that hopefully will replenish the water table and help out some of those wells and some of those ponds.
It would be welcome news for nervous farmers still reeling from their losses and crop damages following a dangerously dry summer. Paul Hollingsworth, CTV News, Halifax.
And SpaceX and xAI have just put out official confirmation of the merger through a statement on the website. They say it will form the most, quote, ambitious vertically integrated innovation engine on and off Earth, end quote. The deal brings together two of the largest closely held companies in the world. And in a separate company memo sent out earlier in the day, the combined company value was put at $1.25 trillion US. That does it for The Close today. Thanks for joining us. We'll see you back here tomorrow.